Hello everyone. So I'm back with the second part of the video, and in the last video we had discussed couple of key clauses including ROFR and ROFO. Now clause 2.8 is the next key clause wherein we are going to discuss tag along right. And there is also another similar right called drag along right, which we'll discuss later on. So let's understand what is a tag along right. So when, for example, two people are going somewhere and you say, I also want to go and I'll tag along with you. This right is similar to that. Basically, through this right, an investor is saying that if someone else in the company is going to sell his or her shares, then the investor will tag along and sell the investor's own shares at the same price and the same conditions to the third party buyer. That's about it. Now let's read the clause subject to promoters lock-in as set forth in clause 2.4 of the term sheet. In the event any of the promoters, sorry, any of the promoters or the other shareholders other than the investors decide to sell their shareholding in the company or a portion of it to any person or a buyer which is a third party buyer, and the investors do not exercise the right of first refusal or ROFR as referred to under clause 2.7 of the term sheet, then the investors shall have the right but not the obligation to require the promoters or other shareholders to ensure the buyer purchases the pro rata equity shares on the same terms simultaneously with the shares of the promoters and other shareholders. See, the point here is just a second. Yes. So the point being made here is, let's say I am an investor in the company. Basically, I am the new person coming in, right? Now, within the company, the existing shareholders have promoters and say existing shareholders, right? Now, if a promoter is going to sell his or her share, if an existing shareholder is going to sell his or her share to a third party buyer, as an investor, I can um, come in and intervene using my right of first refusal, right? I can come in and say that to a promoter or an existing shareholder that at whatever price you are going to sell the shares to the third party buyer, it is your obligation to offer the same shares to me at whatever price you intend to sell to the third party buyer. Correct? And then, given it is my right, I do not have an obligation to exercise my ROFR that we discussed in the last part. Now, in this case, what tag along right is saying that in case the investor does not exercise the right of first refusal, in that case, the investor can exercise the tag along right. Basically, let's say through ROFR, what the investor was doing, the investor was saying that the investor will buy the shares of the promoter and existing shareholders. Now, ideally speaking, this would happen when the investor is very bullish on the company or the investor has some alternative thoughts with the company because of which the investor wants to buy those shares, right? Now imagine a situation where the investor actually does not want the promoter and existing shareholders shares, but still these guys want to sell it. So what the investor can do now is the investor can say that okay, you go on and sell your shares, but now you have to make sure that my shares are sold as well. So now if a promoter or an existing shareholder is going to sell their shares to a third party buyer, in that case, the new investor can come in and say that now you have to get my shares sold as well at the same price in the same condition. Got it? Now understand the point that in my example I said the investor will use a tag along right, but I did not put the other case round that if the investor is selling, then in that case the promoter and existing shareholders can't go and say that the investor has to make sure that their shares are being sold as well, right? Which means that any transfer of shares by any of the investors shall not be subject to any tag along right is what the clause is also saying. Got it? So now understand that in such a scenario, for these guys to sell their shares, they need to make sure that the investor shares are being sold as well at the same time. First thing. Second thing, The investor shares are not liable to tag along rights by other parties, right? And the third thing, which I told you in ROFR and ROFO as well, that the parties to tag along rights might change basis the term sheet and basis at what stage the company is. For example, there might be some companies who might again carve out that within the existing shareholders only if a major shareholder is selling his or her share. In that case, a tag along right is applicable. But if a minor shareholder, let's say someone who's holding just 2-3% of the company, intends to sell their shares, they are free to do so. This might be a carve out which might be agreed upon by the parties. Next clause is ESOP clause 2.9. So once we read the clause, you'll think it's a fairly straightforward thing, but there is one catch to this which I'll explain. See, the clause reads as the company shall implement an ESOP plan constituting at least X percent and not exceeding X percent. Let's say somewhere around 10% ESOP pool has to be created. This clause says that the ESOP pool will be created on a post-issue share capital of the company. Now understand the point. Post-issue share capital, in my understanding, this refers to the share capital post-investor invests, right? So once an investor invests, this clause is saying that the ESOP pool has to be created after, or the percentage of ESOP should be as a percentage of the post-investment share capital, post-issue share capital of the company, correct? But this clause has been inserted in the term sheet itself. So understand why this is happening. This is happening because let's say the ESOP pool is created right now itself, and then as an investor, I'm investing into the company. In that case, my investment is not being diluted for the ESOP. However, let's say had this clause not been put right now, and had this been agreed that once the investment is made, then the ESOP pool will be created, what would have happened then? In that case, once I have invested and let's say I get some X percentage stake in the company, my stake in the company would have been diluted for ESOP creation. So the investor is very shrewd in this case to ask the company to make the ESOP pool beforehand, but that also is as a percentage of the post-issue share capital compared to a pre-issue share capital. So this is the catch here. And as you all know, the ESOP is used for attracting and retaining talent in the company. Next clause is AVM. Affirmative voting matters. This is a very straightforward clause actually. So understand the point here. Um, I told you that I am as an investor. Initially, when I was discussing the board composition, I gave you an example that if let's say I'm taking 20%, 26% stake, and I'm taking one nominee or I'm nominating one director to the board. Got it? And now let's say the board has six directors all in all. Then in that case, my voting power in the board is 1/6, correct? However, through this clause, what I am saying that the company and its shareholders shall not be permitted to take any decision on certain matters, which are the affirmative voting matters or AVMs as we call it, without such matters first receive the approval of the investor director, which means that in this case the investor director directly indirectly has a veto. If the investor director is not approving these particular matters, in that case, the company or the shareholders cannot take decisions on those particular matters. For example, I'll just give you one or two examples of the AVM. For example, um, hiring of KMPs. As an investor, I can say that whoever is key managerial personnel of the company, they cannot be hired afresh without my approval. One, I can say that any borrowings by the company beyond certain limit, maybe XX rupees, XX crore INR, whatever it is, borrowings beyond certain amount cannot be done without my approval, and so on and so forth. So these are AVMs. Now this AVM is for what? For the board meeting. The clause further states that in case of the shareholder meetings, the investor will have a right to vote pro rata to the shareholding, which is normal. Got it? The next clause, clause 2.11, is on liquidation preference, or as we call it, liq pref. This is also a very important clause. Basically, through this clause, we discuss on the subordination. See, ideally in finance, what we study, debt is the highest form of capital in terms of repayment, highest source of funds. That is followed by preference share capital, and that is followed by equity share capital. Now, as an investor, I am investing into the equity of the company or CCPS, which is indirectly equity. Got it? Now, what I'm also doing through this particular thing, LickPref, is I'm saying that within equity share, who will be paid first. So let's say there is a Series A investor, Series B investor, and a Series C investor. And let's say there are the promoters as well. 20% stake, 20% stake, 30% stake, 30, 40, 50, 60, 70, 30% stake. Let's make this 25 and this 35. As a Series C investor, now think of it that the Series C investor has issued this particular term sheet. So let's give the name VJ. Now, what I am coming and saying to the company is that in case you are going to pay your debt, done. You pay your preferential capital, done. But when it comes to equity, I want the first preference in terms of repayment. And how do I do that? I say to the company that in case of a liquidation event, obviously the uh, conversation of paying back money comes only when there is liquidation. You know that. In case of a liquidation, then as an investor, I will be entitled to receive in preference to the holders of other equity shares. As I told you, after debt and preference comes equity, and within equity, I am saying that I'll be in first preference. How am I doing that? I'm saying to the company that you pay me an amount which is equal to the pro rata share of my holdings or my investment amount plus all declared but unpaid dividends, whichever is higher. So understand this. Let's say this is the stake, this is the investment amount. Got it? Now, let's say the company has $150 million left after paying back to the debt and preferential capital. And the investment amount total is 50, 30, 80, $110 million. So in this case, what the company will do is company will divide this 150 basis the stake held by each of the parties, which means as an investor I will get 150 into 35%, $52.5 million. Got it? Which means that in this case I am okay to take this amount because it is higher than my investment amount. Now assume a case where the company only has $80 million. And in this case, out of the $80 million, I will get 35%, which is 28 million. However, I have invested $50 million. So here I am going to take $50 million out of this $80 million through my lick pref because as per the clause, I will be paid my pro rata on the net proceeds or my original investment amount, whichever is higher, which means I will be paid $50 million instead of $28 million. So this is my lick pref. And obviously liquidation event has to be defined somewhere. So it is detailed in the definitive documents, which means the SHA, SSA, or as some people call it, SSHA. Next is the information right. This is a normal clause that as an investor I'm saying to the company that you provide me some of the details on a timely manner. So basically the investor is saying to the company that provide me financial statements on a quarterly basis after 30 days after each quarter. Then I'm saying that you provide me annual financials within 60 days after each financial year. I'm saying you provide me a business plan within 30 days after commencement of the following year. And lastly, any operational and financial information as may be required. Exit mechanism is again a good important clause which is also known as scheduled exit. So see again the concept of scheduled exit comes because the investor is investing for what? For a MOIC 1. I mean, I'm trying to tell you why an investor is putting these clause. So, investor needs MOIC or multiple on invested capital. Second, When an investor is putting money into any company, the investor is putting through their funds, and these funds also have a life. So the investors actually want to exit their investments before the fund expires, because of which this scheduled exit clause is put. Because let's say the fund life is 7 to 8 years, the investor will try to get an exit from the company within 5 to 6 years, and hence this clause is put in there. So the clause states that the company and promoters both shall make reasonable endeavors. Now there are debates on the word reasonable as well. What is a reasonable endeavor? So that is again a legal debate, but anyways, not getting there. To provide exit to the investors by way of an IPO. So an IPO within 5 years in this case. An IPO within 5 years. Let's say if an IPO is not happening, then a strategic sale of the company. Strategic sale within 6 years from the date of closing. And let's say if neither an IPO nor a strategic sale is possible, in that case, a drag along right. You remember I mentioned this along with a tag along right. So see, in case of a tag, promoter and existing were selling to third party buyers, and as an investor, I was just tagging along, right? But in this case, if the contrary happens, in this case, I am going to sell my shares to a third party buyer, and I have the right to drag these two folks to sell their shares compulsorily even if they don't want to sell. This is a drag along, right? Basically, I'm dragging them, घसीट के ले जा रहा हूँ कि तुम भी बेचो. So the clause states that in the event the company and promoters fail to provide an exit in accordance with clause 2.13 subclause 1 above, which means IPO or strategic sale, then in that case the investor shall have the unilateral right to sell their investor instruments to any third party and the right to drag along the promoters. Why is this a right and not an obligation? Because let's say there is a third party buyer who just wants to buy 30% of the company, and as an investor I have 30%. Then in that case I don't need to drag these two, right? However, if in case an investor wants to buy the entire company, then the drag along right facilitates me to not only get my exit but drag these two folks so that the investor can take over the company as a whole, to sell whole or part of the shares. Basically, whatever the investor or the new buyer wants, basis that the investor can drag. This clause does not include some of the other ways. For example, there can be a clause on buyback wherein the investor can force the company to buy the investor shares and pay the investor out of its own net worth. There can be such a situation as well. There can be other methods also, but let's stick to the term sheet for now. 2.14 is on free transferability. It says that subject to clause 2.6, 2.6 was ROFO, subject to ROFO and provided that the investors do not sell the company securities held by them to any competitor of the company, the securities are freely transferable. Basically, it is saying that if as an investor I want to sell my shares to a third party buyer, no one can stop me except in two cases. Let's say if I am going to sell and I have an obligation under ROFO, in that case, before going to a third party buyer, I will also have to offer to the promoters as well as the non-selling investors. Got it? This is because of ROFO. Second, it is saying that in case a third party buyer is a competitor, then I can be restricted to sell my shares to the third party buyer. Otherwise, I am free to sell my shares to a third party buyer. Now, the competitor is also defined in the definitive docs, that who is a competitor of the company. One, for example, imagine a situation wherein 197 Communications, who was the parent company of Paytm, now 197 Communications, if 197 Communications wanted to exit Paytm, and imagine a situation wherein 197 Communications sells the Paytm shares to someone known as PhonePe. Imagine the situation. The plight of Paytm, that the investor in the company is selling the shares of Paytm to PhonePe, because of which now Paytm is controlled by PhonePe. So as a founder, or as a promoter, I would not want my competitor to control my company, right? And hence, this restriction is there that an investor cannot sell to a competitor of the company. With this, we complete all the key clauses. As I told you, clause 2 is very important. Now, clause 3 is documentation and incidental matters. So, we will not spend a lot of time. Definitive docs, as I have told you multiple times, it refers to SSA, share subscription agreement, shareholders agreement, SHA, and in some cases, share purchase agreement if there is a secondary involved as well. Now, this clause further says that the parties shall enter into SSA, SHA, etc., etc., within 90 days from the date of signing of the term sheet, which means that let's say term sheet signed and SSA, SHA closed. This has to be done within 90 days. And why is that? It is because of clause 4 on termination. I'll just cover this clause right now. Clause 4 termination states that a term sheet once signed shall be valid for 90 days only, post which the term sheet shall be considered terminated. This is one thing. The clause of termination also states that once an SSA, SHA or a definitive documents are signed, this term sheet shall be considered to be terminated automatically. And that is why the 90 days period is given here in the clause 3.1. Clause 3.2 is known as CP, and also along with it we have something known as CS, which is not here. CP, CS are basically conditions precedent and conditions subsequent. So conditions precedent are some of the things which need to be done before signing of legal docs or definitive docs, and CS or conditions subsequent are some things which need to be done within a stipulated time period after signing of the definitive documents. Got it? So, for example, in case of CP, this is saying that LDD, legal due diligence, and financial due diligence need to be done to the satisfaction of investors. It says that regulatory approvals need to be taken. It says further that employment agreements need to be signed, AOMOA needs to be amended, and so on and so forth. There can be n number of clauses in CPs. 3.3 is on standstill provisions, which means that these are very generic clauses which company needs to take care of between the 90 days period or between basically the date of term sheet and the date of definitive docs. What this clause says is, for example, within that stipulated time, the company will not do any major property movement or business changes. The company will not do anything other than in the ordinary course of business. For example, the company will not take very big loans, or the company will not do any major RPTs, related party transactions, any major changes in senior employees or share capitals, etc. Clause 3.4 says reps and warranties, or we as we call it R&Ws. Reps and warranties, actually there is a full excuse me, full annexure prepared for R&Ws, wherein the company says that, for example, the company confirms to the investor that it does not have any legal cases except, let's say, case 1, case 2, which means that the company is disclosing everything that it knows about anything that is possible and an investor should know. Basically, if I read the clause, the company represents to the investors that the proposed transaction is in accordance with applicable law, including but not limited to Indian Foreign Exchange Regulations, which means FEMA, and shall not result in company violating any terms in respect of existing corporate or statutory approvals. Now, basically, first, what the company does is the company is giving a representation of all the things which an investor should know, and then the company further gives warranties that in case anything other than these things happen, for example, let's say the company does not disclose a tax case on the company in the representations. In that case, the company actually has given an investor a warranty that for that particular tax case, the investor does not have to bear anything of any sort. 3.5 is on statutory approvals, wherein the company and the investors are agreeing that any statutory approval, if required, will be taken. For example, there might be an approval from CCI or RBI, etc. Events of default or EOD. EOD is defined in the definitive docs. So it is saying that the definitive docs will define the EOD, basically events of default, and what are the consequences of events of default. For example, in case of events of default, the promoter shares might be forfeited and so on and so forth. That is EOD. Now, we have done clause 1, 2, and 3 till now, and none of these clauses were legally binding. But now we come to clause 4, which is legally binding on both the parties. So first clause on clause 4 is on expenses. Basically, this clause is saying for any work that has been done in terms of say due diligences, etc., the company will bear the cost. Basically, the investor is coming and saying that मैं कुछ नहीं दे रहा, तुमको पैसा चाहिए, सारे खर्चे तुम उठाओ. However, I have seen good investors wherein they say that let's say if we are doing a commercial due diligence, as an investor, we will bear the cost of that due diligence. So basically, through this clause, the parties clarify that who will bear the cost of what. 4.2 is on confidentiality. So here they are saying that each party shall keep all the information about the proposed transaction confidential and shall not disclose the same to any third party without prior written approval of other parties. For example, as an investor, I cannot go and say that I've issued a term sheet to X company, and as a company, I cannot go to other investors and say that I already have a term sheet from X investor, and that is because of the confidentiality clause. In case I breach this clause, then I am bound to legal consequences. And then it says that any disclosure to representatives, employees, etc., can be done on a need to know basis, which is fine. 4.3 is on exclusivity, wherein the clause says that for a period of X days, in this case 60 days, the company and the promoters both cannot do any further negotiation, or the company cannot solicit other term sheets, etc., or provide any information to potential investor, etc. Basically, through this clause, they are saying कि आपको term sheet दे दिया गया है, अब 60 दिन के अंदर अंदर अपन 60 दिन तक आप अदर शॉपिंग मत करो. This is also known as term sheet shopping. For example, as employees, when we give interviews, what we do, we take one offer letter and then we try to go to other companies and say हमारे पास यहाँ से offer letter, आप ज़्यादा पैसे दोगे क्या, right? Which is known as offer letter shopping. Similarly, as a company, sometimes what founders do is they take a term sheet at let's say X valuation and then they go to other investors and say आप ज़्यादा valuation पे अगर करोगे तो आप पैसा डाल दो. So through this clause, that is prevented for some days. So for 60 days, that is prevented. 4.1, 4.4 termination we covered above. 4.5 is amendment. It says that any amendment to term sheet can be done by mutual consent. And 4.6 is governing law and jurisdiction. So you define which law and which jurisdiction will be applied. For example, you can say that Bombay High Court will be a governing jurisdiction for this, and Indian law, Indian land laws will be basically the governing law. So here you'll have Companies Act, for example, etc., as the governing law. And with this, all the clauses are complete. Schedule 1 is the pre-closing and Schedule 2 is the post-closing shareholding pattern, which we covered in clause 1. And with this, we complete the entire term sheet. So if there are any questions or queries on the term sheet, please just drop a comment on the video and I'll be more than happy to clear.